First, when there's a lot of borrowing to service debt, there's what's called, the death spiral is what we typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. And then investors know that that's a problem to service the debt. So the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral. You need to borrow more. When the currency depreciates, particularly relative to gold, Bitcoin, or other assets.
If you find this video insightful, don't forget to like, share, and subscribe to our channel. Turn on the notification bell so you never miss an update on economic trends, market insights, and expert interviews. Thanks for watching, and we hope you enjoy the video. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
To me, it's almost like the circulatory system. I think that credit is like blood that brings nutrients to all of the parts of the body. And it passes through a system that is like arteries. And then credit creates debt. And the key question, if it's healthy, is does the debt create an income that is more than enough to service the debt? And that's like, I don't know, eating vegetables or something. It's a healthy process. And if not, credit begins to build up this debt. It begins to become like plaque in the arteries. And you can measure it, just like you could measure it in the arteries. And you can see how it constricts that circulatory system. Because as credit and debt service rise, you see that it eats up more and more consumption because you have to spend that. So you could watch the government do that. You can see that how interest is eating up and debt service is eating up, and that means there's less money. And then you also can see how heart attacks take place. And they're very, economic debt heart attacks. And the way they take place is by looking at the supply and the demand. If you have a lot of debt, and then you have a large supply of debt, that has to be bought. Somebody's got to buy it. And so that when you get to the point where there's debt risks, there's not only the new supply that has to be offered, but there is the possibility of holders of those debt assets selling those debt assets. And so the supply becomes overwhelming relative to the demand. And then what that means is it's the same dynamic as it for the government as it is for an individual or a company, except the government can print money. So when that debt service burden rise, or there's a big supply-demand imbalance, if the government, most importantly the central bank, doesn't print money and buy it, then there has to be a rise in the price of the debt to constrict borrowing, and that borrowing constricted, that credit that is not going to come, will weaken the economy and cause bad economic conditions. And so they can let that happen, or they can print money and buy the debt and monetize it. When they do that, that's inflationary, and it lowers the value of the debt. In either case, you don't want to hold that debt because either there's a debt service problem or there's a depreciation. You get paid back with a greater supply and cheaper money. And that is the dynamics, and that's the mechanism. And because it can be measured, it can be seen in all countries, you can watch it happen. And so like you're going to your doctor, you can measure these things, you can see them, and you can know what needs to be done. And, a good example was in COVID. There were two waves. The first wave was the COVID wave, in which they put out, the government wanted to, and actually did, deliver a lot more money to people, companies, than there was a loss of income. So first wave, a lot of that money. Where did they get the money from? They had to borrow it. The central bank then came in and lent them. That was the primary. Then the second, when President Biden was elected, there was a second wave of that after COVID. It was mostly like a universal basic income thing. In other words, hand people money and we're going to be better off. And so they handed people money, doing that same exercise again. And so naturally, all these people got a lot of money. And so they deposited them in banks, they went out and spent, and so on. And it therefore shouldn't be surprising that we had a big wave of inflation. And we also had a lot of banks buy government bonds, which they lost a lot of money on. And that was that crisis. So that's how the mechanics work. You can't get richer by making money. And the purpose of money,
purchasing power is what matters at the end of the day. What your money's worth, what you can actually buy with it.
That's right. And there are two purposes of money, which is as a medium of exchange and a storehold of wealth. Saving is very important. And if you don't have savers who have it as an effective storehold of wealth, then you don't have a viable long-term credit market.
Yeah.
People don't understand that the bonds become a bad deal. You need that, like any marketplace, you need purchasers and sellers to be able to have an efficient negotiation to achieve a balance without the government coming in and printing a lot of money and make a big mess. It's like they made very severe negative real rates.
Right.
And we know what happened with the severe negative.
Let's get back to the video.
First, when there's a lot of borrowing to service debt, there's what's called, the death spiral is what we typically refer to that. When a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. And then investors know that that's a problem to service the debt. So the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral, you need to borrow more, and so on. So that is also noticed when then there is the key spot is when the debt service becomes large. And then like the real red flag, the biggest red flag is when there's then the selling of the debt beyond the new supply, but the holders of it sell it. And then you can see it in the market action because you can see that long-term interest rates rise while short-term interest rates aren't rising or go down. So it's the free market losing its desire. You have a balance problem in the free market out there. And then you start to see that when the currency then depreciates, particularly relative to gold or Bitcoin or other assets, and sometimes other currencies. But typically, these things happen, broadly speaking, together, in which all currencies go down. Other things like gold, Bitcoin, or tangible values. And so that's what it looks like. That's, the dynamic. So you either see the central bank comes in very quickly.
I just want to highlight the CBO projection, right? So this is the U.S. government's debt as a percent of the U.S. government's revenue, which you indicate in your book is more important than debt to GDP. You've got to look at the actual revenue being generated by the government and how much debt they have. And the CBO highlights this expansion to 700%, meaning the government is going to have a debt level that's 7 times the income it's making every year over the next, I believe this is a 10-year chart. And you propose a bunch of actions that can keep it flat. And so I just wanted to kind of walk through that. And maybe you could frame this up for us a little bit.
Sure. Like that chart, if you go back to that chart, think about that chart as being, your plaque, so to speak, in the arteries and the debt service. So you could calculate all those numbers and you know what the picture looks like. And that is a stability. And so number one is, I call it my 3% solution. Here, the solution is you must cut the deficit, which is the equivalent of bonds selling, down to 3% of GDP. And it's 7.5% expected. Now, different people have different views as to how to cut it. Forget it. I don't really care. Just you have to have a unified agreement. Everybody in Congress and the president and so on should pledge to do that. And then the question is how to do it. But they should know that number.
That's about $900 billion a year.
Yeah.
Roughly. And that means cutting it, as you point out, by cutting the deficit by more than half from where it sits.
Yeah, well, yes, because with the continuing the tax cuts, Trump's tax cuts, that'll be 7.5%, and you want to get it down to 3%. And it sounds draconian, but we did that kind of change from 1991 till 1997. And there are 3 keys to this. Do it soon, fast, when the time is good, when the economy's good. In other words, do it now.
Now.
Okay. The temptation is going to say, well, we're going to ease into this and we're going to be there and we're going to do it in 3 years from now. But if you have a bad economy, you cannot do it. Okay. And that's the worst. So we have the best economy, and the sooner you do it, the more you're going to do it. So 3% solution, do it now, and recognize that you have to deliver it. So if you're having, let's say, cost cuts in government, you have to own the number. So everybody's got to pledge 3%. Now, there'll be arguments as to how to get there, but you have to own the number. So much so that you'd say, if it's not 3%, throw me out of office, because I've got to deliver that number. The other thing about it is to realize that if you make those moves, the bond market it will benefit. You see this, and so interest
rates will go down.
Right, and interest rates going down, interest rate expense is most important.
So when the president does an interview the other day, and he says, we need to get them to cut interest rates by 1%. And he's speaking about the central bank. He's effectively trying to force the central bank or coerce the central bank to take rate action when, if we were to cut spending, I think this is so important. If the federal government were to cut spending significantly and quickly, the market would naturally react to lower rates.
That's right. Okay.
I think that is so important for everyone to hear.
He's right. If you look at my calculations, you need 100 basis. If you get 100 basis points cut in rates, that's equivalent to significant cutting in spending. So he's right. But if you do that without the other parts, you're going to take money away. You're going to make it less desirable to own these things, these bonds.
Right.